Today we're going to talk about how venture capital can make you rich, and I'm going to show you exactly how anyone can get started with venture capital. And I'm also going to show you examples and how I'm using it for myself in order to build my own wealth. So, who is this video for? It's for highly ambitious people that want to build real wealth, and also your location, age, gender, so on, they don't matter at all. All of those are irrelevant because anyone can aim to become an investor. So, why venture capital? Because high inflation, which means that higher returns are required in order to preserve your wealth. Also, companies are staying private longer to maximize returns. This is a new trend, which means that there's less potential for public investors. The barrier for entry in real estate is also too high if you want to go into that asset class, and not everyone can get a loan to invest in real estate. For example, I probably cannot get a loan because I'm an entrepreneur. And banks usually don't like that unless you're a very high level individual, which they will, of course, want to give you a lot of money. But at least I'm not at that point. Most certainly, most people are not there yet. On top of that, venture capital has low or no maintenance at all. You can choose to get involved more, but it's optional. Biggest advantages that I see in venture capital is access to insider knowledge. Now, this is not the type of insider knowledge that's legal and you will use in order to make illegal trades. No, this is more like information that other people have less access to. Trends in the market, what works and what doesn't. Also, a ton of other lessons that you can learn from the people building those companies. Now, at this point, most people will wonder, isn't venture capital risky? Yes, it is. But that risk can be reduced through diversification. There are a lot of studies that you can read, but most of them will say something around 65% of companies that you invest in will lose you money. 31% of companies will barely make a return 2 to 3 times the initial investment, which barely will cover inflation if you're looking at this in the long term. And 4% of companies will win big. That means that out of 30 companies that you invest in, at least one will make a big return. 60 companies, 2 or more, and so on. You get the idea. Now, if we're looking at a more practical example, we can see that if we're investing $3,000, 30 companies, so $100 per company, this is just an example. You can see that for 65% of companies, you invest, let's say, $2,000 and you get nothing back. For 31%, let's say that you invest $900 into 9 companies and you can get back a $2,000. The big winners, 4%, you invest $100 in them and you can get back $4,000 or even more. Now the total return is $6,000. So you've doubled your investment in 5 to 10 years, which is around 10 to 20% per year depending on the duration, but it's way above what most people can achieve in the stock market or with real estate. Now this is a very basic example using those percentages that I have mentioned, but in reality, you can actually improve those percentages and you can get better returns. How you can do that? Knowledge. You can learn more to make better choices and you can specialize in specific domains where you have an advantage. You can choose to get some early exits, which will mean that you will offset some of the risks and you will get some earlier returns. For example, at one point, I had the option to take back an investment that made me 3 times the initial amount in just 1 year. Now, those are rare examples, but you can kind of get the idea that you can tweak a bit the percentages, choose to take your money out earlier. Now, that also means that your returns will be smaller than if you waited. It's better to decide to take those early returns only on the companies that you no longer believe that they can grow even bigger. Now, you can also choose to double down on the winners, to follow on rounds in order to increase your returns. Now, just imagine that you found that 4% company. Ever since you initially invested in them, they've made significant progress. Now they are raising again. Usually, you would want to invest again in them in order to increase the returns that you will get in the end. You initially invested in them $100 and they eventually IPO for 30 times the initial investment, you will get back $3,000. But if you decide to invest later on, your returns will be even bigger. Another way how you can increase the percentages of how many companies fail is through later stage investing, which will reduce your risk, but also you will get smaller returns. This line shows that your profit skyrocket because the risk is reduced after this funding gap, which is around the Series A part. If you decide to invest for it around the pre-seed seed stage, your returns are bigger. That's how you get those 30 times, 60 times returns, but the risk is that much bigger. Around the Series A and after that, your risk is reduced, but also the returns. Another way how you can increase those percentages is through a unique advantage. So either you have a domain insight or the skills required to grow the investment. That means that you can help the company grow through client referrals, through partnerships that you can arrange between them and other companies, or even helping them improve their operations. Everyone will have a unique advantage that they can leverage in order to increase the potential returns from their investments. And it's always better to invest around them if you have the chance. For example, let's say that you're specialized in sales, so you have a better perspective about how the domain works and what it needs. So your best chance is to invest in companies that are trying to work in this area and they align with your vision how the domain works. Going on to the next topic, how you're making money from private investments. You can either get dividends, which can turn into a cash flow, which you can then reinvest into other companies. But this situation is quite rare because if a company still has potential to grow, it's better to reinvest the money back into the company to grow it even further than to distribute dividends. IPOs are another way how you can make money from private investments. They are quite rare, but they provide huge returns. If you don't want to wait 10 years in order to get your money back, it's better to look at companies which are looking to get exits through different methods. Another more popular method are mergers and acquisitions. Those are the most often, and they happen because other companies want to get into a specific domain, and it's better for them to acquire an existing company than to start building something from zero. The returns for mergers and acquisitions vary a lot, and they can happen at any stage, but they provide a quick way for you to get out of a company, get your money, and reinvest it in other opportunities. Another way is through secondary market deals, which will mean that you will get to exit early out of a company by selling your shares to other interested investors at a later stage. Let's say that you've invested in a Series A company a year ago and now they are trying to raise a Series B at double the valuation, but you no longer believe that they can grow that much faster. There's a moment when you sell your shares to other investors and you get to reinvest them in other opportunities. The last way how you can get your money back from private investments is through liquidations, which happen if the company can no longer continue or they don't believe that the potential is there anymore. Those events can generate some small returns, but it's important to note that investors will get paid less. So after all of the employees, the suppliers, and if there are any loans that need to be covered. So now that we have covered the theory behind it, let's say how you can get started. So what do you need to get started? A source of income or some existing funds and a lot of patience. Those are the only things that you need because the skills and the knowledge, you will learn them through the process. So step-by-step plan, you will need to first learn as much as humanly possible about investing and also building and scaling a company. It doesn't matter if you're doing this on your own or with somebody else, you will have to understand the deal. The second step after you've learned as much as possible is to actually test the waters, put your knowledge to use by investing into small deals. I believe there's no better way to learn about a specific subject than through practice. You can do that without too much risk by leveraging crowd investing platforms. They will allow you to invest in deals put together with other venture capital companies that know what they are doing, learn from them with small tickets from $100 to $25,000. I've also started on crowd investing platforms and it has enabled me to learn a bunch of lessons before I decided to go big, which is the next step. When you finally decide to go big with venture capital, you will have two options. The first one is to join a fund and give your money to somebody else to manage it for you, or you can do it on your own, in which case you have to assume all of the risk that comes with choosing a specific deal. If you decide to go with a fund, you will have more diversification, so your risk is significantly reduced because they invest in a lot of deals, but you will also have less control over what deals they invest the money. What's important here is to check their fees because if they are too high, your returns will be too small in the end. And also, you need to know that they have bigger minimum tickets around 25K or 50K. If you decide to start investing in private companies on your own, I suggest that you look at both crowd investing platforms also angel groups, accessible tickets. The opportunities that you will see in both of them will go through an initial screening, which will make sure that at least you're not getting scammed. After you've learned everything, tested the waters, and you've decided to go big and you've placed all of your money in companies, it's time for you to wait for your big win. And that's everything that you need to know in order to understand how to get rich with venture capital. Now it's time for you to get started. Thank you for watching until the end. Don't forget to subscribe if you want to see more content like this. Also, let me know in the comments if you have any other questions.